Okay, welcome everybody to this webinar presentation on the topic is in options analysis, and it is options performance between dates. And it is about a new template in the EdgeRater program that allows you to see some very insightful information into how options have performed between two specific dates. I'll give you a quick example here. You would have seen this in the email that I sent out for the invite to this webinar. The example is if you look at the right-hand chart over here of Apple, you can see how Apple has performed between two dates by visually looking at the chart. And between this entry and the exit, you can see Apple gained 18%. And often it's useful to know what options would have done over that time frame too. This template allows you to draw a line on the chart and see the report that is shown on the left here, which is basically a report of every option that was available on both the start and the end dates for all of the expirations and all of the deltas, and charts it basically to give you a chart as in the top area. The bottom area is just the actual numbers that go into making that chart that you see in the top area. So we're going to go into how to view this information, how to run the template, and some little tips and tricks on to help you use the template. So let's go ahead and jump into EdgeRater. This was released on Thursday, I believe. Late Thursday was when I finally got this ready, and it's taken a little while to generate this template. Personally, I've actually had this information available on my computer, and I've been using it for over a year. But it's always been a challenge to get this information out so that everybody can use it, because, as you can imagine, an options database is incredibly huge. Because you imagine a stock database is pretty big, but for every bar of a stock, you may have 2 or 3 or 4 or 500 options for that particular bar. So the amount of data is explosive, and it's pretty impossible to put that onto an individual's computer. And downloading that would be time consuming, and it would take up a lot of storage space. So the answer is to put that information into the cloud, and the template now accesses that information from the cloud. So having said that, that's a slight difference between the way that this template runs and any other template runs. Most other templates use data that exists on your hard drive. This one goes out to a web API and grabs the information. So I'm going to give the standard example here. If you find the template, you'll find it under options analysis category. There's 3 templates in there now. You have the expected move template, the IV ranks template, and the new one, which is options performance between dates. I've also got it in my favorites over here. By default, if you don't change anything, you're going to see that it's going to run the example that I just showed you, which is for Apple, AAPL, and then the from and the to dates are over here. So I just wanted to say, having released this on Thursday, I've had a few comments just about the fact that at the moment, when you type a symbol in, it actually has to be in uppercase. I will be changing that so you can type upper or lowercase, but at the moment, you type a symbol in, just make sure it's in uppercase. And then once you've done that, you can just hit run. Don't have to worry about selecting a symbol list over here because it's not going to this list. It's actually going to a web API. So I'll hit run here. And as quick as that, it has gone to the web API and it's fetched all of this information in this table here. So if you remember from the chart I just showed you, this should be very familiar. If I click on, I'll just give you an idea of the cells in this report which are sensitive to clicking are the symbol cell and the date cells. So if you click on any of those, the chart on the right-hand side will update to show you the symbol, and it will also highlight the entry and exit date that has been chosen. So it gives you a good visual indication of the point in time and the stock that you're looking at. In the report, you can see that it also gives you the underlying percent gain. So from this bar over here, which was 6.721, up until this bar here, 7.1421, there was an 18% gain in Apple. Now, but if we look at the chart of options, we can see that the biggest gain in options was at the 0.1 delta option in a 39-day to expiration, and that gave a 2,000% gain. So that was the highest percent gain, and then you can just very, very quickly and visually see all of the other deltas as well. And then if you need to get specific, the chart obviously is great visually. And then if you need to get specific, you can look down in the table down here and look at the various deltas down here in this area from negative 0.9. Obviously, negative delta are your puts. And so, yeah, there's a question here. Does it work for puts and calls? Yes. So the puts are displayed on the left side of this chart over here. These are deltas from negative 0.9 down to 0. And then the calls are over on the right-hand side. These are deltas from 0 up to 0.9. And so, yeah, so that's the way it is arranged. Calls and puts are shown. So that's useful. What I've also noticed is that people have been going back to, you run this report one time, and then if you want to look at another symbol, people have been going back to the templates and selecting a new symbol in here and running the template again. That is not necessary. And a much better way to operate this is to now draw a line, excuse me, draw a line on the chart and this template. I'll show you exactly what happens here. So say you're now looking at this chart, you see another area of interest, and you might be inquisitive as to what happened to the options, say, in this period here. Well, you can take the trend line tool, the line tool here, and then draw a line from here to here. And you'll see the chart is updated to show the entry and exit. And now this chart also has updated. And you see there are gaps in this chart just because not all of the deltas were represented over those periods in the historical data. And you can see that the number of expirations that we have has decreased because we're looking at a longer period of time. So obviously, we're not showing 30-day to expiration options here because 30 days would have taken you up to well, the entry was March 24th, so a 30-day expiration would have gone to April 24th. But we were trying to find performance between these two dates. So we're ignoring all of the options that expired before the exit date in this report. What this has done, when you draw a line on the chart, it produces the same report, but it puts it into a separate worksheet within this spreadsheet. So you see now I've got a report, the original one that I ran, and then this report bracket 2, which is the new one that I ran. And every time I do a new line on the chart, it's going to run over that new period, and it's going to generate a new report. This is now report 3. And they'll just accumulate inside the original report. And that's why you don't have to go back to the templates and run a new template for a new symbol. So another question I had was, how do you get a new symbol if you're not going back to the template and entering the symbol name? Well, there's several ways to do that, but by far the easiest way is, if you know the symbol that you're trying to find, is to just click on the chart, as I've done here, press the space bar, and you can actually just enter a symbol. Again, uppercase, you can choose. We could say SPY. And now we're looking at a chart of SPY. And now I could just draw my trend line between the points that I want to find the answer for. On this chart, the clear, interesting area is this sell-off from here down to the low down here. This would be a good example of puts being winners. As you see, it goes out to the web API. It may take a few seconds because it's, obviously, as you can imagine, this is calculating a lot of data. We have up here, we see how many expirations we have and how many deltas we have. So imagine each one of these figures in here, each one of these numbers, the server has actually calculated that based on those deltas and expirations. And more than that, what it's done to get to a specific delta is it's done an interpolation between the two closest deltas. So you're not always going to find an exact 0.2 delta, for instance, but you might find a 0.18 and a 0.24 or something like that. And then there's an interpolation that can be done to arrive at the theoretical 0.2 delta. So that's how that works. So you can imagine the server is doing a lot of work for each one of these requests. That's why it takes a few seconds, but still, it's actually incredibly fast for what it's doing. So in this case, let's just run through what we're seeing here. In this case, we're looking at this. This was the early 2020 sell-off due to the coronavirus sell-off, and you can see the best possible gain was over 8,000% in a 35-day to expiration option at a negative 0.1 delta. So that would have been a put because it's a negative delta, would have been an out of the money, a very far out of the money put. And it would have been an 8,000% gain. That's 80 times gain, 80 times the original investment would have been the return on it. So another question I had was, how far does this data go? How far back does this data go? It's as far as the options data that is available. A way to find that is if you use your chart layouts and go down to the options layouts, you'll see in the options layouts, you've got information for implied volatility. If there's information for implied volatility, we have that information on the server, and we can go to that period of time. But the server only holds data from 2013 onwards. So if I go beyond 2013, here is where the data starts. So it's January 1st, 2013 is when the data is available from. You cannot choose a date before that because we do not have historical data for that period. But the stocks that are represented are all stocks that have options. So if a stock has an option, it's in the database, and you will be able to get this information. Another interesting thing I should show, when you start playing with this, you'll have a lot of questions that you'll want to have answered by the report, and so you'll probably start using this quite a lot. But an interesting thing to look at is if you are looking, and if you do have your implied volatility chart showing, you can see where implied volatility is low and where it's high, and you can see the effect that actually has on the return of the options. So, for instance, in this case, the implied volatility was relatively low at about 13%. By the time the low point of this sell-off occurred, implied volatility was actually very high. Incredibly high. Let's say the 30-day implied volatility was 68%, incredibly high for SPY. So that helped to boost this return to the 8,000% return. And a decent comparison would be what happened in the recovery from this level up to, say, this point over here. It's a very similar number of points that's been recovered, a slightly longer time frame. But let's take a look at what happened over this period. I'll run a line up from here to here. And now we can see that the biggest gain here was a 2,500% gain. So quite significantly less than in the sell-off. And one of the main reasons for that is the implied volatility went from a level of, say, the 30-day implied volatility as an example, 62-ish% all the way down to 25%. So the options lost a lot of their premium just based on the drop in implied volatility. So that's a very good example of how implied volatility is extremely important when you're buying and selling options. You can find other examples of this as you just scan through your charts. You'll want to, I'm sure, just play around and see the effect of implied volatility. Also, it's interesting to take a look at the effect of crossing outside of any known band. A good band example here is the implied volatility or expected move EM30, 30-day expected move bands. When stocks cross outside of the EM30 band, what is the behavior of the options when that happens? Because, and the reason that's important is because the expected move is really the level that has been priced in for the options. That's what the options are expecting in terms of their move. And when price crosses outside of that expected move, that is not expected. And so that does add an extra bit of information to, or a bit of juice to the underlying options. Okay. What else did I want to say about this? So yeah, that was one way to change the symbol. Obviously, press the space bar. Another way is to click on your symbols display over here. You can just select a new symbol, just like normal. Once you've got a new symbol selected, provided there are options available, and I'm looking at the CBOE weeklies list, so I know they will have options. But I can look down at implied volatility just to make sure that we have data, options data for it, and then I can just draw a line between 2 points in the chart, and so that's what it shows. The other thing to note here is, as you are running the report, you'll see a message on the just to the right of the dates, the stock symbol and the dates. The message will be, it's a message about the web API. The API is essentially the endpoint that's being called to get the information. So there could be some issues if you don't have internet connection, if the API is down. All kinds of issues can occur because the data is not on your local machine. You can have all kinds of connection issues or maybe other issues on the server. So this API OK is just an indication that the call was received OK. And if you make the call, you draw the line, it makes the call out to get the information from the website, then and there's some error. This will say API error, and then you'll know the call was actually tried, but there was an error. And you can try and look at your information to see, the line that you've drawn to make sure it makes sense, that you actually have options data for that point, and so on and so forth. Okay, so let me look at some of the questions here. Okay. Yeah, so we looked at puts. There are a few questions about puts. We did look at when puts are profitable. Is it possible to have an example for the next month? Oh, I think you may have been talking about a specific chart I was looking at. Obviously, I've lost that context now, so I'm not sure what month we were looking at. Another question about could you do the same analysis when selling options? Well, this is options pricing, so obviously it's just telling you the gain of an option. So if you buy the option, you'll make that gain. If you sold the option, you'll essentially incur any gain that's shown in the option. You'll incur that as a loss if you've sold the option. So you can infer selling from this as well. Okay, so yeah, it's educational on right. So that's the idea. This isn't a template that's going to predict how you can make money with options. That's not the idea. The idea is to give you information about how option pricing has moved in the past, and just to give you a way of looking at and analyzing the information for yourself. So that's really the idea of this particular template. Allow you to do some research, because what I have found is that you often have a question about, well, if the stock moved this amount, would I have been better to have been in an option, and what option would have been performing the best? And that the idea of this template is that you can just view any historical moment and find that information. You'll often find, and it's quite educational, if you look at, say, we'll go back to SPY as an example. So SPY has just been in this up grind for a long time. So calls have generally been the best in SPY, but take this period here where there was some disturbance in the force. And if we draw a line from, say, this peak to, or this level here, this date to this date, where price didn't really move, well, it moved between these dates, but by the end of this date, from one date to the other, price was essentially the same. So here you can see, this is a good example. You can see that the puts lost money and the calls lost money, essentially, except for the very high delta calls. So, and this is how people make money when they're trading iron condors, because both the put side and the call side would lose money. Iron condor, people who've traded the iron condor, sold the iron condor, will have made that money. But iron condors probably would not work in a uptrending environment, because one side of the spread would be extremely unprofitable and would lose the money for the condor. So iron condors are best if price stays within a certain range. Example shown right here. Another okay, so yeah, let me just show. It is quite important to a question that came up actually in email over the weekend was somebody was saying, I don't even see on the chart where I can look at symbols and scripts and layouts. And by the way, layouts is where you would choose your implied volatility. So you can see that. But you might not even be seeing these tabs, because it's possible you have minimized or tidied up this layout. If you go up to the chart menu, I can actually turn off those configuration panels. And the point of that is if you're never changing the configurations, you just get more real estate to view the chart. But for this case, you can just turn them on, and then you'll see these extra panels. Okay. Yeah, Phil, I have no idea what that would be. I'd have to see what you're doing exactly. Maybe you could send me some information. Obviously, I can't answer that here. Yeah, but you might find errors occur. You might find this is a new template, so I'll be looking out for error reports. And if you do find errors, yeah, I would be very interested to hear them, so I can get them fixed as soon as possible. Now, another great way to use this template is in conjunction with your other favorite templates. So, and I should show, this is another chart that's kind of hidden over here, but if you scroll over to the right of the report, you'll see another chart, which is just another way of displaying the same information that's shown in the bottom area. And this time it's taking each one of these series is essentially a delta series. And then the x-axis is your expiration. Okay, so example, you can see the line down here. This is a 0.1 delta line at various expirations. So you can see how that's affected. But I find it way more insightful and interesting to look at this chart over here, which is why this occurs first. And I hardly ever look at that other chart, but you may want to. Okay, so let's take a look at this in conjunction with some other templates. Very useful. Let's look at the linear regression template. I'll run this. Okay, so the linear regression template, just to refresh your memory, is all about taking different periods of time, 5 days, 10 days, 21 days, etc., and then figuring out the linear regression line between in that time frame and what the annualized percent gain would be. So it's essentially the steepness of the linear regression line. So you can sort it and slice this in many different ways, but I'll take as an example the 21-day set of columns over here, and I'll just look at annualized percent gain, the highest. We have a couple of candidates here. There's VIR at annualized percent gain of 484%, and then there's Acadia Pharmaceuticals annualized percent gain of 335. So this linear regression template is linked to the linear regression chart. So you'll see a linear regression line, and you'll see the percent slope over here and the slope change down here. So now, having selected this, I'm not looking at implied volatility anymore. But what I can do, still, I could show implied volatility and then unlink this to the template if I always wanted to see implied volatility. But if I leave everything connected, what I can do is just drag this template to the lower area down here. So now I've got the upper area is my options performance. The lower area is any template you choose. And so then what I can do is I can still draw the line on the chart to see over this period how options performed. Okay, so we're looking at high performing stocks, and then how did the options do over that the same period. So this is an example of a gain in Acadia, a 36% gain in the underlying. And you can see, again, it's the low deltas. So the extreme out of the money options that perform best. And that's always pretty much, well, not always, you'll find cases where that's not. But the thing to be careful about is not to assume that these low deltas are the best options to trade. And I'll explain why I say that in a second. Let's take a look at a couple of others of these. So you've got oops, draw my line over here. Yeah, so we've got JDST. Let's take an example here. We'll see how the options performed here in this 25% gain in JDST. You've got incredible gains in the 0.1 delta. But the reason that you've got to be careful with this is that a 0.1 delta option is out of the money. It's far out of the money. Most of the time, it's going to end up losing everything. And occasionally, it's going to make a lot of money, as is shown in this report. The problem with a very out of the money option is that the bid-ask spread is probably going to be quite wide. The volume traded is going to be very low. And so it's not always going to be easy to get the volume that you want, or even to get a good price. This template is assuming when it's doing the calculation, is it's taking the mid price between the bid and the ask, and it's using that as the essentially that's called the mark. It's using that as the calculation point. But you may not be able to get the mark, okay, when you're trading. If there's no volume, you're probably not going to get the mark. And when you buy, you're going to have to pay up to the offer, and when you sell, you're probably going to have to hit the bid. So, so your experience with those out of the money options is going to be quite different. But in some cases, you can. Those options are quite heavily traded. So this is a good indication, but you have to go to a trading platform, something like Thinkorswim, and look at the volumes, look at the bid-ask spread, and make a judgment call on that. But it sort of seems a little seductive that in this chart that the very low deltas are the ones that are going to make a lot of money, and you just have to be very careful because, as I say, most of the time they're going to lose 100% of what you put in. So you can take these. You can take these if you have an inkling that something's going to move big. Not only though do you have to know the direction of the move, you also have to know the time frame. It's very easy looking back on a chart like this. Oops. It's very easy looking back on a chart like this to pick a low point and a high point and draw a line and see some fantastic results in some options, as I've done right here. Let me just see where that came in. Oh yeah, it's down here. Okay, so it's very easy to do that because I have the benefit of hindsight. But when you're trading the option down here, say you're going to buy a 0.1 delta, you have to also know the duration. You would have had to have guessed that a 24 day to expiration would have been this move would have happened in that short time frame. If you get those two things right, so you can be paid big money for that, but oftentimes you're going to lose 100%. So you have to, if you're going to be trading these very low deltas, you have to have a better strategy of managing money. You can't invest a lot. You would have to take very small amounts. So often, and as you heard from Dave McMullen, it's better to trade something that's at the money or maybe slightly out of the money. So say a 0.4, 0.5 delta, 0.6 delta, something like that, 0.7 maybe. But this template definitely helps you with that as well, just to see how those options perform too. Okay, so I've got linear regression. That's a good template. Always a good template, the linear regression template, just to look at stocks that are moving. And as you probably remember, you can narrow this down even further by selecting your annualized percent. So these are things that are moving quickly, selecting where the price is in relation to the Bollinger Bands. So you might want to filter that down to where price is towards the lower end of the Bollinger Bands or towards the upper end. And you can also choose a bandwidth, which means that you're looking at things that are moving very consistently. And so if I say chose a bandwidth, I can say filter to between, or I should have said just greater than. Let me do that again. Filter greater than, of course I should have said less than, so I can do that. Less than, and we can choose an example here. We'll say less than 0.1. Okay, so now I've got things that are moving up in a very narrow linear regression channel. And you can choose also filter based on %B to see where exactly price is in relation to this channel. If is it at the lower part of the channel or towards the upper part of the channel. So just that's just a little refresher on the linear regression template. There are videos on linear regression template in the EdgeRater video YouTube channel too. Okay. Another template I wanted to show in conjunction with this is expected move. Let's just run that for the CBOE weeklies. John says, is there a way to get line plot of the expected move? Is there a way to get line plot of the, do you want to expand? I'm sure, sorry, I'm not really sure what you mean by that. Do you want to, maybe you can type in a bit more information there. Okay, but I'm looking at the expected move template here. I can see now the things that have the highest expected move over a particular time frame. So currently, out of the entire CBOE weeklies list, I know that the highest, this is sorted by implied volatility. So the stock CRM has the highest implied volatility, and it is expecting a move higher of 400 plus 495. So this implied volatility, which is extremely high, 300 odd percent. And I'd have to look at think or swim to because it just does seem a little high, but maybe there is some reason for that that I'm not currently aware of. So let's take a different example. It probably is correct, but let's just move down the list a little bit. We can go to something like AMC. Everyone's heard of AMC and the crazy moves that it's been making. So currently with AMC, it has a high implied volatility, but we can see that this implied volatility is only 50th percentile because just recently it's had incredible implied volatility. So this is, now we can see that price here is outside of the expected move band. Okay, when price crosses outside of, as I said before, when price crosses outside of these expected move bands, then it's going beyond what the traders originally thought price was going to be 30 days prior, because we're looking at the 30-day expected move bands. So when that happens, that's an unusual, unexpected. Let's say that's unexpected. So it's always good to think about at that point, options trading. Is it better to sell options? Is it better to buy options? And what kind of options do you want to buy and sell? So you can always do some experiments down here to figure out what potential moves would have been. Okay. A line plot of the price of the expected move. So I think, well, essentially the expected move bands are the line plot of the price of expected move, John. So they are drawn around price, and they are drawn at a level of the plus or minus expected move, but shifted 30 days into the future so that you can line up where price is versus where the expectation was. And then you can always change that to be, instead of using a 30-day expected move, you can choose any other period that is supported. And there are 12 different periods that are supported with implied volatility and expected move. If you want to see what those periods are, a quick way to do that would be to look at the options analysis layouts, and then you'll see in the headings here the implied volatilities that are supported. So here it's a 3-period, a 7-period, 14, 21. That's the shorter term ones. 30-period, 45, 60, and 90 for the medium term, and 120, 180, 360, and 720 for the longer term expected moves. The other thing you can do is to get a line plot for expected move is actually called a cone. In order to see the cone drawn at the end of the chart, you just have to kind of put a few extra bars in the end. So you expand the chart right by, let's say, 60 bars, and then scroll over to the right. And now we see a line plot or a cone, essentially, of expected move drawn out into the future. And you can see where that lines up with the expected move bands. 30 days, this line, the cone, should actually hit the bands. That's how you can see that it's been shifted into the future, the bands have. So this is your expected move cone. Price should be inside this expected move cone 68% of the time. I know that looking at AMC, and if I look at my lower plot down here, I can see that price, the percent of time that price has spent inside the bands over the last year is 63.49%. So it's actually been outside of those expected move bands more than it's been inside. So AMC, in general, it's been better to be a buyer of calls and puts because it has gone outside of expectations. That's the way that I tend to look at that. Okay, let me just check on here. Sorry, 1 second. Okay, good. Yeah. So sorry, Johnny, if that wasn't the answer to the if that wasn't what you were getting at, then yeah, sorry about that. And then there's a suggestion that maybe you're looking at, rather than seeing a continuous line there, you wanted to see horizontal lines based on weeklies. So we don't show that in EdgeRater. It's more of a continuous line basis. Okay. Okay, another interesting template to look at in conjunction with this, and I've picked just a couple, a lot of them are interesting actually, is to take a look at the 220 EMA breakout template. I like this template because it is just a complete CAN system in a box. It has entries and exits, very, very tightly specified. The template tells you what's currently open in the trade. It tells you what entered into a buy state today. And it shows you what the current max gain is of all of the stocks in the list based on this system. So here we can see that definitely Sienna is the winner here with a 34% gain based on this system. It entered 11/1/21 and it's been 34 bars in this trade. It's based on the 220 EMA upside breakout system. That template is in the Stocks and Commodities magazine, and basically it's called 220 because you enter the trade 2 bars above the 20 EMA. If there have been 2 bars above the 20 EMA, then the entry is whenever price crosses above the high of the highest one of those 2 bars. So in this case, it would have been at this level here. So anyway, that's just I'll tell you a bit more about this particular system, but it's interesting to come in here to see, well, if you weren't trading the stock, if you're trading this system, but you weren't trading the underlying stock, okay, then what would you have, could you have done with options? So let's draw our line with options. And this will show you another way of doing this, different technique. So instead of taking the line on the chart itself, and drawing it from here to here, I can actually just come down to one of the sub areas. And the blue line in this sub area is when the trade is on. So all of these, whenever the blue line is a 1 value, the trade has been entered. So I can draw a line down here from the entry to essentially the exit here. And that will translate to, well, actually I hit I hit that wrong. So I'll just come back down and do that again. From here to here. Okay, so now you can see on the chart it's drawn the labels for entry and exit. And so instead of this 34% gain in Sienna, you could have potentially, again, trading these super out of the money options, you could have made 1,600% or 16 times gain if you were able to pick the exact correct day to expiration. Then you could have made that Also, obviously, as I was saying, it does depend on whether the option is liquid or not. But you can also just look down here and say, well, you prefer to trade at the monies, then the 0.5 delta is the at the money. So you can see on the various, and you can say, well, I don't actually like trading short-term days to expiration. I might want to trade a 164 days to expiration. And then in the chart, in the table down here, you can look and see that 164 days to expiration at 0.5 delta would have given you a 300% gain instead of this gain over here of the underlying of 34%. So again, much better return in the options. But in order to figure out whether the options are worth outright buying or whether you need to do a spread, it's always good to look at the implied volatilities. So if you come down here, you can see that when this broke out and entered into this trade, implied volatility in the very short term options was quite low. In the medium term options was about 0.75%. To find out, 75% percentile. But to find out the exact percentile, you can choose the you can choose to find the exact percentile. You can actually use the chart that's linked to expected move, and then you can see that it is 61st percentile. So that was at the exit, and then at the entry over here, it was down at quite a low. Well, actually, the entry was over here, right? So yeah, so it was pretty. It was pretty high implied volatility. Okay. So let's see, is there anything else to say about this template? On the face of it, the template is very straightforward. I know a lot of people have tried using it. I've had a lot of good feedback from it. I would like to know what you think of it. And so once you've had a chance to play around, I would like to see some information, get an email from you and some feedback on what you think. This, in my opinion, this is incredibly powerful information that you will not find, in my opinion. You won't find this information anywhere else. You can find information about options performance on a single option in many different places, but it's rare, and I haven't seen another place where you can see the entire complex of options displayed on one screen and so quickly. So this is incredibly powerful. Yeah, exactly. What else? So in terms of the updating of the data, so this, as I said, when you run the template, it's very different to other templates in that it does require access to the API. So this template requires that you have an active template subscription. If you don't, it will give you the opportunity to resubscribe. But that's one requirement. The other thing is that the options data is calculated and updated obviously after the market's closed, because it's using end of day options pricing. It's using real options pricing. This is not made up options pricing. It's actual options pricing. It should be available. Well, it should be available many hours before the next trading day, but it does depend on when we get the data in-house here as to when it can be processed. But as soon as possible, it gets processed and updated. Oftentimes, though, I find you don't necessarily want to see what the latest bar was, or the game between the last bar and the current bar. Often you want to go back in time in history, and that data is always available. The only thing that's going to be available as an extra data point is the very last bar. So if, for instance, you wanted to see the price change between, let's go back to SPY, that's a good example. Sorry, I click over here. Sometimes when you click on the charts, you can't press the space bar, and often find I have to open the symbols over here. I can just type SPY, close that down. So if I, for instance, on Friday in SPY, as you can see here, looks like there was a little bit of a sell-off. Okay, sell-off on Thursday and more so on Friday. So what was the difference in price between Thursday and Friday? Just a one-day price move. So let's see what options we're doing between this day and this day. And that's the thing you couldn't do until you have that latest bar's worth of data. Okay, so we can see that in just one day, SPY lost 1%, but some of the puts, you could have, well, it seems fairly consistent in this 6-day to expiration chain here, that you would have been able to achieve 40% in pretty much all of the deltas of those. And then if you had chosen longer days to expiration, so you chose a 30, that would be 1 month, then 20% would have been the potential gain there just in one day. So if you had an idea that this sell-off was going to happen, that's a decent trade. Also, implied volatility at the moment in SPY is not super high. I mean, we are at 71st percentile, but you also look at where we've been when we had the Hindenburg omens over here, and then we had the sell-off here. Implied volatility did get quite high, above 30%, but it's now down at 20%. And if you scroll back through the chart, then you can see where implied volatility has been on this run up, and the lowest level it had gone to is about 15%. So we're above there a little bit. You would always expect implied volatility to start moving up before it moves higher, but it has been as high as 30 just very, very recently. So implied volatility is reasonable for the expectations. It is just a direct reflection of expectations. For those who don't know, I know a lot of people do, but the implied volatility is just calculated on options pricing. And it's basically options pricing is just what traders are prepared to bet on the market, where they think price is going to be, and implied volatility is calculated from there. So if implied volatility is high, traders think price is going to move a lot. That's essentially how expected move is calculated. Okay. Okay, so Tom, on the expected move charts, can the multiple plotted lines be turned on and off individually? No. Those lines are essentially the entire complex. So if you've chosen a one-day period, you're going to get a lot of bars, a lot of lines in here. And the reason for that is between 2 consecutive days, you're going to have all possible expirations. Yeah, you're going to have the 1 day to expiration, the 3, the 5, 7, all the way through to leaps. And as you look in this chart in the table down here, you can see we've got days to expiration from 4 all the way through to 764. So a lot of information in there, and all of that information is plotted on the chart. If the chart is too difficult to exactly see the numbers, that's why the table is there. You just scroll down to the table, and the table has all the information. For the moment, there is a bit of an issue, and you may run across this. If you have gone back to the template and chosen to run a new template, say I wanted to run against Netflix, okay, and click run. Now what has happened is I now have 2 options. I now have 2 performance between date options reports. And the problem that you're going to find with this is that they won't both update if you draw a line on the chart. And so you may be confused as to why one has not updated and the other one has. So it's best to just close one down and just just keep one report open. That is the best way to have this working at the moment. That will be modified in the future. Okay, so here you can see this Netflix move from the 200 period moving average, the Netflix move out to outside the expected move bands. A nice gain. And these charts also give you an idea of whether, because you can see this is very conforming. The lines are very smooth between all of the different deltas and also between the expirations. This is a very conforming options complex where everything is nicely, the chart looks nice and clean. But as you've seen, there have been others where the charts look all over the place. And that often would indicate that the options are less well traded potentially. So that's another thing to bear in mind. When you see something like this, you know that there are a lot of options. The volume is probably quite good. And that might be a good, that might be one of the stocks that you trade options on. Anyway, if anyone's listening here and has any immediate feedback, let me know. Do you think it's a good session? Is recorded? Yes. Let me know what you think about this template here. I can tell you that the amount of work and the amount of data it's taken to produce this is quite a lot. The amount of data that's stored online to generate this information is about 1.5 terabytes, which is quite high. Requires a fairly decent server in order to process it. So this is super powerful, and really I'd recommend you probably, if you are trading options, to take a look at this. I have, as I say, I have had this on my machine for over a year, and it just, whenever I'm looking at other reports, I always bring this in because I always have the question about options on those reports. So it's super useful. And Phil, if you want to send me that report you had for the error, I would be interested to see that. Yeah, I think we've come to time. We're not going to go over today. I know when we had, we're fortunate, and I was hoping Dave McMullen might be on today, but he did contact me yesterday to let me know that he's not actually feeling so well today. So it's unfortunate he's not here. But he did want me to just say that he wanted me to convey that he actually really likes the template as well. So I'll let you know that. As I say, let me know as you work through it. Let me know any questions as you work through the template and you use it on a regular basis. And just keep me posted as to what you think and any issues you find. Appreciate everyone turning up today. Good to see you all. And I'll stop it for now and see you next time.